Well, we are here talking about risk management, and our invited today is Mark Shore. He works. He is the executive director of the Arditti Center for Risk Management at DePaul University. Uh, he also has been writing to a lot of places, connecting university and the industry, and have a long experience in the marketing. And to start our conversation, Mark, first of all, thank you very much to be here with us. And I'm going to start with our first question that you are the executive director of the RD Center for Risk Management at the DePaul University. So could you tell a little bit about the center for us?
Sure. So it's the Arditti Center for Risk Management, DePaul University here in Chicago, and that's where I am right now in Chicago, Illinois. And it's named after Fred Arditti, and so he was both faculty at DePaul University in the finance department. He was also the chief economist at the CME, Chicago Mercantile Exchange, and this was probably in the early '80s or so. And he did other things within the industry as well. And but it was a combination of those things they did, and so it's named after him. He also, when he was at the CME, he led the team that developed the very successful Eurodollar futures contract. But he believed in bridging the gap between academia and industry, and that's pretty much that legacy is what the Arditti Center tries to do. So um, we will we reach out to industry. We try to connect with industry. We try to get the students connected to industry. We do a lot of events, and the events will have a combination of both practitioners as well as academics who are presenting at it. To give you an idea, next week we are doing a joint event that we've been doing for several years with an organization called NIBA, National Introducing Brokers Association. So it's an association for the derivatives industry. And the theme that we're going to do this year, maybe something that a lot of people seem to be talking about these days, artificial intelligence, right? AI related to financial services. And we have both practitioners and academics who will be speaking at this and kind of going through it's like what it really is, and then also how it's being used in different parts of financial services, specifically to derivatives. And we're doing that. Then later in the month, we're doing a joint event with the School of Accountancy on ESG and talking about it both from an accounting standpoint as well as an investment slash risk management standpoint. And then we have our big annual 10th annual cyber risk conference that we do, which that has gained a lot of traction. A lot of people know about it. We have people who are, we have the tech people, senior management. We also bring in lawyers. We bring in regulators, people from the FBI, the Department of Justice, Secret Service, to talk about it from various aspects of of cyber risk, right? Because it runs the gamut through our entire organization. And so we do lots of things like that. And so right now, we've got several of them coming up. I can't hear you.
Yeah, I forgot. I would like to know in general terms, of course, but in general terms, could you talk a little bit how the risk is managed?
So how risk is managed, and that's a really big question. So here's the way I look at it. Risk runs through everything, right? Your personal life, your career, organization, businesses, transactions, you name it, there is always some form of risk that's there. So how you manage it depends on what it is you're doing. So here's like a couple of simple things, right? I tell my students, because I primarily teach courses on risk management and alternative investments. So what I'll tell my students, like, okay, if you think it's going to rain out, well, how do you protect yourself from getting wet, right? You take an umbrella with. I do a lot of bike riding. So every time I get on my bike, I'm taking a risk that I could get injured, right? There could be an accident. I could fall off the bike, whatever, the bike gets damaged. So what are the different things that I can do to try to mitigate that? In a business, you have both capital markets type of risk, and then you also have enterprise risk, right? So, and those also overlap. You have companies that hedge, some that have exposures to various markets or risk and don't hedge. So if you think about from the capital markets perspective or commodities perspective, you could be using various derivatives, futures, forwards, options, things like that to try and mitigate your risk. Since I spent most of my career in industry and specifically in alternative investments, one of the things that I teach my students about is the framework of due diligence. And it's just the concept of what can go wrong, right? You can take that, you can apply due diligence, any industry, any function. It's just trying to understand the topic and what are the potential problems that could be there, right? So you don't want to have any bad surprises later on. I mean, let's say like you're a company, you're looking to purchase another company, right? So you're going to do the due diligence. You want to make sure you understand what it is you're buying, that there are no negative surprises that pop up afterwards. If you are an investor, you're going to invest in a money manager. Same thing. You want to do the due diligence on the manager to understand who they are, what they do, not just the portfolio, but also the back office. Because you could have a money manager that's running a pretty good portfolio, but running a really sloppy back office. Could there be potential for fraud? Are there regulatory issues? Are there just other issues they have? Are there technology issues, right? So there's all these different aspects to think about risk. And that's why it's like, it literally runs through every part of our lives. Some are small, some are large, and you have to try and prioritize and decide, well, what really matters. But where there is risk, can there also be opportunities? Can you turn those, I don't know if you're familiar with the term turning lemons into lemonade. And taking a bad situation and turning it into something good. So is there an opportunity there that you can potentially exploit, that you can find? One of the things that I think about with that, and I've talked about this in some of my papers, is that when I look at volatility, like if you think about like the distribution of returns, or you look at, say, a volatility index such as VIX or VSTOXX or VolQ, I often think about volatility is like cholesterol. There's good volatility and there's bad volatility, right? The good volatility is the upside volatility when you're making money, right? That the bad volatility is when you're losing money. That's what you want to try and control for. As a former trader, that good volatility, I'll take that every day. But it's the bad volatility I want to try and control for. So that's part of what you have to think about. What is good and what is bad in risk management or volatility or any of those areas.
Yeah. And you are an expert. You are an expert on alternative invests. Could you talk a little bit about it?
Sure. So to give you a little bit of background to this, I mean, most of my career has been in alternative investments before I went to academia. Right? I started on the floor of the Chicago Board of Trade, futures markets, one of the oldest exchanges in the world, futures exchanges. And from that, I did different things within the world of alternatives, primarily focused on what's referred to as CTAs, commodity trading advisors, and then managed futures. And also somewhat with hedge funds. But if you think about alternatives, so you have to kind of take a step back and say, well, what's the definition of a traditional investment, right? So if you think about it, it would be considered long only stocks, long only bonds, and cash, right? The big generic umbrella definition for alternatives would be everything else. However, if you want to define that a little bit more, right, and elaborate on it, well, you could say it would be hedge funds, managed futures, commodities, currencies, private equity, private debt, infrastructure, real estate, collectibles, and the list goes on. But that's the big world of what we're talking about here, right? And in more recent years, like past 10, 15, 20 years, alternatives have been slowly catching on. They're still, it's not mainstream. It's still kind of like something that's off to the side, but you're finding more and more investors who are looking at it, especially when we go through moments when there's stress in the markets. So early 2000s, during the financial crisis, during COVID, and now, and really since COVID, right? So you have a lot of investors, both individuals as well as institutional investors, who are starting to look at alternatives and say, how does that fit into my portfolio, right? Does it make sense to have it in there? A lot of people think of the 60-40 model of stocks and bonds, right? And so this kind of takes it beyond that you're allocating to other asset classes, right? So it gives you exposure to various asset classes, different strategies. And then the question is, how can it potentially help you, right? What does it do for your portfolio? So these are things you need to think about as well. Some of these strategies, some of these investments, if you're looking for diversification, may not really offer you diversification. Other ones may be the ones that you really want to go for diversification. So it kind of depends on what you're looking for. So if you look at, let's say, hedge funds, you look at all the strategies of hedge funds, well, some of them like long short or long only bias, things like that, they're going to be highly correlated to equities. So it doesn't really offer a lot of diversification to your portfolio. It offers a little bit, but it's really an extension of your equity exposure. Now, if you want something more diversified within hedge funds, then you could go to global macro strategies. You go to fixed income arbitrage. You can go to managed futures. Those are the ones you would want that would give you diversification. So, think about a big picture. It offers you a much larger exposure to more assets, more revenue streams, and potentially it can offer you diversification to your portfolio.
Okay. Going to another talk, last week you were at the Illinois Economics Association, where you presented the conference Trading Derivatives Like a Professional Money Manager. Could you bring a little bit to us here in Brazil and here on YouTube a little bit about the main topics of your conference?
Well, so there's the conference itself, which is like any academic conference, right? There's multiple sessions happening throughout the day, different topics. So there were things on inflation, labor. I was on the session related to derivatives. We had during the lunch presentation, we had a keynote speaker who is from Bureau of Labor Statistics talking about some of their data and what they do, which was really interesting. And with my particular topic, our theme for this year was to explain some aspects of derivatives and to talk about it from a trading perspective. So for me, that's a really easy thing to do because I spent a good chunk of my career doing that. And particularly, I used some examples from when I was at Morgan Stanley in New York. I was part of a CTA. We traded futures and forwards. And we were what's referred to as a trend following CTA. So I used those ideas to explain how you could trade the futures markets like a professional money manager, and the idea of how we got in and out, how we tested the models, the due diligence we did of the models, all those sorts of things, and particularly the risk management. And so one of the things I always like to say, and I tell this often to my students, is that what can make or break a money manager is how they manage their exposures in the market, how they manage the risk, right? It's one thing to get into the position. Once you get in, what do? Right? How do you get out? Do you get out on stops? Do you use profit targets? Do you use a combination of things, the profits? and stops? Do you get out 100%? Also, how do you get into the positions? Do you leg into the position? Do you put it all on at once? Um, how do you trade one market or one sector? And when I say one sector, meaning like the grain sector or the energy sector, or do you diversify across multiple sectors, multiple markets? Um, so it's things like that that I was talking about and saying these are common methods that are used within industry, and it should be known that here's a way that you can trade.
And you have been writing to Nasdaq and Reuters, for example. You were the host of the Your Diversification, the internet show. So could you talk a little bit about the gap between industry and the academic world? And also, could you tell us a little bit about your experience with a non-specialist audience and readers, and about the importance to dialogate with society, going outside the academic world?
Yeah, so let me start with that. So, I mean, talking to people outside of academia, so within industry, which is actually where I spend most of my time. Um, I do consulting work for industry. Coming from a research background, I write research, but I write it in a way that's educational. So it helps to, I use it to explain the products or more so the markets. And as someone who used to develop training models, what I'm always looking for is understand the behavior of a given market, the nuances. How does it behave? Because once you start to understand how it behaves, you can then start to understand how to put together some sort of trading model for it, right? So I've done things like that over the years. Yeah, I've done it for NASDAQ, for Eurex, CBOE, and so it's primarily the audience is going to be industry. These may be people who are new to the industry, maybe people who are more seasoned. I've had some hedge funds over the years who said they came across some of my articles about volatility. I was writing about VIX that trades at CBOE and VSTOXX that trades at Eurex. And he said it gave them ideas for trading strategies. So it's great because then my research is actually application. It's being used. Um, but yeah, so coming back to the first part of your question about between the gap between academia and industry, there is a definite gap. And I think part of it is there's perceptions on both sides that kind of get missed. They, they may misunderstand each other in certain ways. Oftentimes, practitioners think academics write these really long, complicated papers to read. And it's true, some of them do, right? They can write these papers that are like, 50 pages, and it's like, unless you're like really deep into the weeds of it, it's hard to understand it. Or they use a lot of mathematical terms and academic terms. And I think part of that is there are some really great ideas that academics come up with, but there is a gap that needs to be bridged. And part of that is if they can make it more digestible for industry to understand, I think that would help quite a bit. And like when I go to some academic conferences and I'll listen to people presenting papers, and I'm always looking at it from the perspective of a practitioner, and I'll hear them talking about something. And then there's like this one little idea within this whole paper. And I'm like, that's a really cool idea. That's a little gold nugget that, hey, maybe that could be used in some way. But I think if there's more conversations between industry and academia, I think that helps. And trying to make the papers more readable to a non-academic audience really helps. There's also what I found is within industry, there's a learning curve too for people, like particularly in financial services, different parts of it, to understand different aspects of the industry. And I think that's also where academics can help because they're good at teaching. So they can come in and help bridge that gap as well on the educational side.
It's when what you were speaking. So I was thinking it's the same in the material in Portuguese, in Spanish. So it's something that the academic world has in many languages, in many countries. It's something like it's almost the same. So, how important is the research at the university to the industry, and how important is to a professional have some skills that the research get through the undergraduate to studies, master, and all this PhD, for example.
So, first part of your question about how important is research at a university to industry, right? So it kind of builds on what I was just talking about, that um, there is some really good research all over the world that people are doing. And I think it's important to get it out and get it to industry, because once again, there can be these little ideas built within a big paper that can be really helpful, or there's some concept or framework that an academic has developed that can be very helpful. It's also obviously from a business standpoint, it's good branding for a university, right? Shows there's a lot of thought leadership coming out of that given university, or just academia in general. So I think things like that are always good, but it's still, I think it's always like coming back to, where does industry and academia meet? Where can they find common ground? Um, as the executive director for the Arditti Center, when I took over as the director a few years ago, I started reaching out to my network in industry and saying, how can we help you? As an academic center, how can we help you? Or as a university, how can we help you? Um, the one the one common response I would get is, oh, we need to hire. Like, great, not a problem. I've got a building filled with potential candidates I can send to you. But still, beyond that, how can we help you, or how can we help industry? And I think having those kind of dialogues, those kind of conversations, are really helpful, because I think now when academia talks to industry, they also get a better sense of what the concerns are within industry, or what the needs are, and they can also then start to focus more on, how do we resolve those problems, right? So through academia, through research, how do we do that?
Just I will ask you just a minute because I just sent through the chat the link to people who are participating uh, to sign their presence here, and I have to say to them that the link is available to the university generate the certificate to the audience. Uh, After that, Mark, going to the end of our conversation, I would ask you your final considerations, please.
Um, Final considerations, like final thoughts.
Yeah, yeah, final thoughts.
Okay, well, since the theme is risk management, is one of them is just always kind of think about, well, yeah, the one question that I always put out to my students is, what can go wrong, right? Always kind of think about those sorts of things. Maybe little items, maybe large items, but always try to keep an eye out for what potentially can go wrong. Are there ways to mitigate the risk? Some people or some companies will just kind of like ignore it, or so-called put their head in the sand, and just kind of don't worry about it and just let whatever risk happen. Or there's others who are more proactive, and they want to look at it and say, what can we do to try and prevent problems from occurring, right? If you're a business, and if you can mitigate your risk, you think about it, that can create more stability of your business, more stability of your revenue stream, your cash flows. it can give you a stronger reputation as a business. It can help you with your credit ratings. There's more companies that may be willing to do business with you, right? Versus a company that is not really mitigating risk. Well, vendors or partner companies may not want to do business with you. Banks may not want to lend money to you. They see you as potentially a large risk. Employees may not want to work for you, right? Because they see this as an organization, as a risky organization. Um, Stockholders may not put much trust into you either. So, yeah, I mean, to think about what what are the different types of risks that are out there, and particularly like as a business or as an organization, what can we do to mitigate them?
Mark, thank you very much to be here with us. I have to say thank you to the people who are watching us right now and people who will watch us later because the video will stay here on YouTube. And well, that's it. Thank you very much. Thank you, Mark.
Thank you for inviting me today.
Okay, bye bye.
Bye.